Welcome to the deep dive. This analysis is built for you, the person who wants to get past the headlines and, really understand the machinery of a business.
Today, we're doing a fundamental analysis of Senores Pharmaceuticals Ltd. They're a global generics player, and they just released their Q2 and H1 results for FY26.
And for this, we've gone through everything. The investor presentations, the conference call transcripts, and financials going back 3 years, right up to September 2025.
That's right. Our mission here is to look at their business model, their financials, P&L, balance sheet, cash flow, and then really scrutinize their efficiency and future strategy.
And the key takeaway, the thing that really jumps out, is this incredibly ambitious guidance they've maintained.
It is a 50% revenue growth and a staggering 100% growth in Peri-T for the full year.
Yeah.
That suggests some pretty big structural changes are taking hold.
Okay, so let's dive right in. The company engine. At its core, what is Senores Pharmaceuticals and how are they making their money around the world?
Well, at its heart, Senores is a research-driven, formulation-focused company. They're not chasing volume in those, mass-market generics.
They're avoiding the big price wars then.
Exactly. They specialize in niche, under-penetrated, and complex generic products.
And where is this revenue actually coming from? Is this a domestic story or is it more export-driven?
Oh, it's predominantly export-driven. For the first half of this fiscal year, the regulated markets, so we're talking the U.S., Canada, and the U.K., that accounted for a dominant 66% of total revenue.
66%. Wow.
Yeah, a huge slice. Emerging markets came in around 20%, and the remainder, that comes from domestic segments like their India-branded generics and API business.
So in this global generics industry, which is just teeming with competitors, especially out of Asia, what's their moat? What makes Senores so difficult to copy?
Their moat is, well, it's both physical and regulatory. It comes down to local manufacturing in the United States through their facility in Atlanta.
And that one facility makes all the difference.
It does, because it gives them key regulatory certifications that a lot of India-based exporters just don't have. It creates a pretty significant barrier to entry.
Okay, can you be more specific? What are these certifications and why do they matter so much?
Absolutely. The two most critical are DEA and BAA compliance.
DEA, so they can handle controlled substances.
Precisely. That's a highly regulated and, importantly, a high-margin niche in the U.S. Then you have BAA, which stands for the Buy American Act. Being BAA compliant lets them get into these long-term, very stable U.S. government supply contracts.
Oh, that's a fascinating detail. So it suggests their U.S. business isn't just relying on that really volatile retail generics market.
Not at all. Management estimates that 60 to 70% of their entire U.S. business is channeled through partners who supply these stable government contracts.
So that shields them?
Massively. It insulates them from the typical price erosion you see everywhere else, and it offers real protection against potential future U.S. tariffs.
You also mentioned product complexity. Is there actual evidence that they are truly focused on these niches?
Oh yeah, the evidence is right there in their portfolio. They have the second highest proportion at 60.7% of ingredients with what's called competitive generic therapy, or CGT, exclusivity opportunities.
And for our listener, what does CGT status actually mean?
It's a pathway for an accelerated FDA review and often a 180-day exclusivity period. Gives them a huge time advantage, and sometimes they're the sole supplier for a complex product, which, leads to that initial supernormal profitability.
That focus on compliance and complexity, it really establishes their structural advantage. So let's pivot to the financials. How did that translate into actual profit in the last 6 months?
The translation was, well, this is dramatic. As we said, consolidated revenue grew by 66% year over year, but profitability, that just surged ahead.
The bottom line grew even faster than the top line.
Much faster. Take EBITDA, that's earnings before interest, tax, depreciation, and amortization, which is really our best measure of pure operational cash profit. That grew 88%.
88%?
And then PNIC, or profit after tax, that was up an incredible 114.1%.
That points to a huge margin improvement. Structurally, where did that efficiency come from?
It was a very clear shift in their product mix towards higher margin products. In Q2 specifically, the consolidated EBITDA margin shot up to 31%. I mean, that's a 750 basis point increase year over year.
And that was just from new products?
Mostly, yes. It was driven largely by the launch of their own higher margin products during that quarter.
Okay, but if we break down the segments, there's a huge disparity, isn't there? The regulated markets hit a fantastic 40% EBITDA margin, but the emerging markets segment is stagnant at what, 6.2%?
It is, yeah.
If that segment is barely profitable, Is management just wasting capital there, or is there a bigger strategic play we're missing?
That is a critical question. And yes, the low margin in emerging markets is definitely a drag on the overall profile right now. But management sees it as a necessary long-term play.
A long-term bet.
It is. They have 824 products currently under registration in these markets. So the low margins you're seeing today, that reflects the heavy investment needed to register, launch, and manage everything in those places.
So the idea is that once they hit a certain scale, that margin profile will improve dramatically.
Exactly. Management's target is to stabilize the emerging market EBITDA margin somewhere in the 15 to 17% range eventually. And don't forget the India-branded generic segment that grew 7.6 times in H1, and it's targeting solid margins of 18 to 20%.
So the high profitability from the US is basically funding the setup in India and the long-term potential in emerging markets.
That's the strategy in a nutshell.
High reported profit is one thing, but as we always say, quality profit has to translate into actual cash. Let's look at financial health, starting with cash flow. What's the quality of their earnings?
This is where it gets really fascinating. The cash flow turnaround is probably the most reassuring metric from these results. We're looking at OCF, operating cash flow.
And just to remind everyone, OCF tells us if the reported paper profit, the PAT, is actually turning into cash in the bank.
Right. It signals high-quality earnings. And the net cash flow from operating activities, it just flipped dramatically. It reached a positive 24.2 crores in H1 FY26.
And what was it before?
It was a negative 45.9 crores in the same period last year. So that is a major, major reversal. Total OCF for the half year was about 31 crores, and management seems pretty confident this is sustainable.
That's a huge marker of improved efficiency. What operational changes drove that? What did they actually do?
The main driver was a crackdown on working capital, specifically customer collections. Debtor days, which is just the time it takes for customers to pay them, improved significantly.
How much?
It dropped from a high of 177 days all the way down to 114 days. That freed up a lot of capital that was tied up in receivables and immediately boosted their cash flow.
Okay, but in this high growth phase, they must be spending a lot on CapEx. How is their debt, their leverage?
Leverage appears to be under control, which is crucial. We saw non-current borrowings reduce slightly between March and September, and current borrowings were also brought down quite a bit. It shows they're actively managing debt even while they're funding big expansion projects.
You mentioned the great improvement in debtor days, but the overall working capital days still went up, right? From negative 16 to a positive 88 by March 2025. Is that a red flag?
Not necessarily a red flag, but it's that mixed picture we have to look at. The improvement in collections is a clear operational strength, but the overall expansion in working capital days suggests they are, still tying up more capital and inventory to support that 66% revenue growth.
So it's a cost of scaling up so quickly.
It is. And as long as OCF stays positive and keeps rising, that expansion is manageable.
Capital efficiency is so important when a company's growing this fast. Let's look at the key ratios, the ones that measure how well they're using investor capital and borrowed money.
Right. So we need to look at ROE and ROCE. Let's define them simply. ROE, or a return on equity, tells you how much profit the company makes for every single rupee shareholders have put in. Their current trailing 12 months ROE is 11.8%.
Okay. And ROCE?
ROCE, return on capital employed, it's a bit broader. It measures how well the company is using all the capital, so that's the owner's money, plus any borrowed funds. You can think of it as measuring how hard all the money in the business is working. Their current TTM ROCE is 11.4%.
Now here's the critical context. The recent profit growth has been fantastic, but their ROCE has actually been cooling off. It was 18% in March 2022. Now it's 11.4%. Does that signal a fundamental inefficiency, or is it just a timing issue?
This is the central analytical question here, and it primarily signals a timing lag, which is pretty typical of heavy capital expenditure cycles. But it is a trend that has to reverse, and soon.
So they've been spending a lot of money.
A huge amount. They've deployed massive capital into expanding that U.S. facility and setting up new operations. That capital hits the denominator of the ROCE calculation immediately. But the revenue and profit from that new capacity, the numerator, that won't fully show up until the new lines are running and new products are launched.
So the decline is expected because of the investment phase, but the market is going to want to see that investment pay off pretty soon.
Absolutely. Management is guiding for a sustainable consolidated EBITDA margin of 28 to 30% from FY27 onwards. If they hit that, along with the improving cash flow we talked about, it should theoretically drive a really strong upward correction in both ROE and ROCE. That's the main hurdle they have to clear.
And this is where it gets really interesting. Let's look at the blueprint for future growth. What are the key drivers the company is betting on to justify that 100% pay-T growth guidance?
Their future strategy really rests on four main pillars. First, aggressive expansion of the NDA portfolio in the regulated markets. I mean, they acquired 20 ADAs and commercialized 10 in just the first half of this year.
Okay, that's one.
Second, a steady scale-up of their CDMO-CMO business, also in the regulated markets. That portfolio is now at 32 products.
And what about outside the regulated markets?
Third is improving the profitability and portfolio in emerging markets by leveraging those 824 products they have under registration. And fourth is the aggressive scale-up of branded generics in India. They're targeting a pan-India presence by the end of FY26.
That kind of growth needs a lot more capacity. What's the CapEx plan look like?
The U.S. facility expansion is critical. They're adding third and fourth production lines in Q3 and Q4, which will boost their capacity from 1.2 billion units up to 2 billion units a year.
And looking further out.
Further out, they're planning a sterile manufacturing facility. This is for injectables and biologics CDMO, planned for Q2 or Q3 of FY27. That pivot towards complex, high-barrier sterile manufacturing is a huge signal about their long-term margin focus.
Okay, let's talk obstacles. To pull this off, management has to execute flawlessly. What red flags or major risks did the company explicitly mention?
They highlighted three significant risks. First, emerging market headwinds. Getting those 824 products to market is going slowly right now because of, geopolitical situations and dollar fluctuations affecting import permits.
Things they have very little control over. What's their plan B for that?
Their plan B is basically to double down on the U.S. By leveraging that facility and their BAA compliance, they're building a stable base. But the second big risk is just pure execution risk. Hitting their guidance hinges on launching 15 to 16 ANDA products in the second half of this year. That is a very, very tight timeline.
And the third risk?
Regulatory inspection risk. Their new API facility, which is key for their cost control and backward integration, is up for a USFDA inspection in Q2 of FY27. Any delay there really impacts their long-term supply chain.
On a positive note for regulatory risk, they did proactively address a major industry concern, didn't they?
They did. Management explicitly confirmed they've discontinued their cough syrup business entirely. That lets them sidestep all the severe regulatory and reputational risk that's been tied to that segment globally. It shows proactive risk management.
So after all that, what does this mean for our listener? Let's summarize the balanced scorecard, focusing only on the critical points from the sources.
Okay, we can boil this down into the three most compelling positives and the three most significant negatives.
Let's start with the upside. What are the three most compelling positives?
First, explosive profit growth and guidance. PAT growth at 114% is just massively outpacing revenue growth. It strongly supports their full-year guidance and shows operating leverage is really kicking in.
Okay, number two.
Second, the cash flow quality turnaround. That decisive shift to positive operating cash flow, driven by getting paid faster, signals high-quality earnings and much better operational efficiency.
And the third positive.
Third is their strategic differentiation in the U.S. That local manufacturing, the DEA compliance, and all those stable government contracts, it provides a sustainable margin shield against price erosion.
And now for the necessary caution, the risk factors we have to highlight.
First, efficiency ratio flatness. Despite the great profit numbers recently, capital efficiency ratios like ROCE are stagnant. It implies the returns on all that heavy capex haven't materialized yet, which creates immediate pressure to perform.
Right. What's the second risk factor?
Second is the emerging market lag. That segment is still a very low-margin business, and it's suffering from execution delays because of external factors beyond their control.
And the final one.
And third, high execution dependency. The ambitious guidance is just so heavily reliant on the timely, successful launch of a huge number of new products in the next 6 months, plus getting all that new capacity online on schedule.
This analysis really paints a picture of a company using niche specialization and a smart, vertically integrated model to drive some incredible profit growth, all backed by a really crucial improvement in cash conversion.
Precisely. And here's the final thought to leave you with, looking at their longer-term ambition. Given their established FDA, DEA, and BAA compliance in the U.S. and this new sterile manufacturing unit planned for FY27, how effectively can Senores leverage all of that to position itself as a strategic, maybe even indispensable CDMO partner in the super complex and profitable U.S. biologics and injectable space? That is where the long-term structural margin expansion will ultimately be tested.
Food for thought indeed. Thank you for joining us on this deep dive. We hope this gave you the shortcut you needed to be truly well informed.